Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by investment strategist Ryan Grabinski to talk all things markets. Ryan, how are you doing today?
I'm doing well, Ross. Always good to be back.
Yeah, great to talk to you today, and we'll do a bit of a grab bag as we start the second half of the year. And the number one question that we're getting, and I'm sure the number one question you all are getting, is just when does this end? When does the sell-off kind of bottom? What are we looking for to identify that time? So I'll turn that question back on you. What are you all looking for to identify a bottom, or at least get a little more comfortable legging back into the market that's now 6 months into a sell-off?
Sure. Yep. It certainly is the number one question we're hearing from clients these days. Obviously, we don't have the magic formula to be able to call the bottom exactly. But what we do have is we have a checklist of, call it, 15 different items that we're watching. I'm not going to go through each item, but you can see from the items that are on this list, these are the 15 items that we're watching. I will say that as of now, none of them really look close to being near the market bottom. So what we did was we looked at the previous market bottoms going all the way back to the 30s, and we looked at what these readings of these metrics were during those periods. So I'll take you through a few here, but if we look at the trailing price to earnings ratio, right now it's trading at about 18 times earnings. Typically, when we get to a market bottom, it's trading closer to 12 times earnings on the average. Very similar for the forward price to earnings ratio. Right now we're at about 16 times on looking at previous market bottoms. It averages about 11 ultimately at the bottom. I think the other, kind of the other two and ones to really sort of focus on here, and the first is high yield spreads. It doesn't have as much history, just given the high yield market. It hasn't been around since the 30s, but it does, in the last three bear markets, spreads have blown out to above 1,000 basis points. Right now we're at about 580 basis points. So, there's certainly that we're not getting that signal just yet there. And then the other one really is unemployment. Unemployment is ultra low right now. It's still at 3.6%. Historically, on average, it's north of 5% at a market bottom. So, we are starting to see some more layoff announcements. So we wouldn't be surprised if we started to see unemployment rise from here. But nonetheless, our checklist really isn't showing that we're at that market bottom yet. Obviously, we could get a bear market bounce. We've seen those in the past. So we don't want to kind of conflate the two with each other.
Yeah, that makes a lot of sense. And one of the other things that I think you all are probably watching and we're watching is inflation, because this particular episode is very much related to the Fed raising interest rates to combat inflation. So with that said, we have another inflation print coming out soon. I wonder, what are you all looking for, and what do you expect to see when that comes out?
Yeah, so obviously inflation has been a hot topic lately. Last month the reading was 8.6% on a year-over-year basis. I think there's a growing narrative that we're kind of reaching this sort of peak inflation. I'm not so sure that we're going to reach that. We're going to see that peak. It's possible that the inflation reading that comes out next week is actually north of that 8.6%. The Cleveland Fed does a inflation now casting where they show that the month-over-month increase in inflation is expected to be just under 1%. If you kind of apply that to the historical number, or the last month's number, you can actually get a reading that's 8.7%. So the peak inflation story is certainly one that we're hearing a lot about. Obviously, the Fed is raising rates. Another concern of ours with that story is the fact that historically, when you get these elevated, when you get these Fed tightening cycles, a lot of individuals want to say, hey, ultimately the Fed's going to have to halt their tightening cycle, and but in the past, the Fed hasn't really halted their tightening cycle until the Fed funds rate was actually above the rate of inflation. So we have a long way to go there as well. Obviously we're at the upper bound is 1.75%. Inflation's at 8%. So the two are going to have to meet in the middle. So ultimately the Fed probably isn't going to pull back from our perspective here, at least in their tightening cycle.
Yeah, and in addition to inflation and rates, it seems like the next shoe to drop, or the next part of the story, is earnings, which have held up really well in the face of a lot of headwinds so far. But we're about to enter another earnings season, and I think the expectation is starting to be for companies to talk weakness and talk about some of these headwinds and revise their estimates lower. So what are you expecting heading into this earnings season, and what are you all forecasting?
Yeah, that's certainly, guidance is going to be very important this upcoming earnings season. I think, overall the S&P is expected to grow around 6%. Now, I will say a lot of that is actually a function of the energy sector. If you exclude the energy sector from that calculation, earnings are actually expected to decline. So I think, I personally am going to be focused on the energy sector as they have such a large potential to sway earnings this quarter. If we look at what the pre-announcement ratio is, and that's the negative announcements to positive announcements, it's actually 1.7 to 1.7. That certainly isn't an elevated reading just yet. So that typically you kind of get this. If you see an elevated reading there, it's usually more of a bullish signal. But the low reading is sort of suggests that we'll see muted returns throughout the earnings season. I think if we kind of thinking ahead, I mentioned at the beginning that guidance is going to be important. I think we're starting to actually see some of that play out in the 2023 estimate. So 2023 had been hanging around $252 a share for quite some time. And over the last week, we finally started to get some of those revisions lower. So right now that estimate sits right at 250. I think ultimately, we're of the view that ultimately the earnings estimates are going to have to come in from here, especially with the growing narrative, I should say, that there's going to be a recession over the next, call it 12 months. So I think we're looking for those figures to really come in from here.
Yeah, well, it's a lot to chew on between earnings, inflation, and then your bear market bottom checklist. So we really appreciate the time. I think there's a lot for us to take away from this. So Ryan, thanks so much, and hopefully we'll get to chat again soon.
Thanks, Ross. Have a great weekend.